Morning, guys. How we doing?
Hello.
Oh, fantastic. How you doing?
I am great. So, who are we missing here this morning? I don't see my friend Shenjiang. And who else? So we've got Martin, Victor, and Alex in that team. Let's see. So we have Jaden. Do we have Micah? Missing Micah. We got Peter. We got Annie, right?
Let's see.
Okay. Well, there's Shinjan. Good. Good to see you, brother.
And
So
Micah just got on.
Oh, Micah's on?
Dang. Whoa.
Yeah.
I still don't see my. Oh, there she is. Good to see you, Micah. So I think we might have everybody then. So, Will, yep, and Megan, and Paula, and Fred, and Noah, and Brandon. Okay, cool. So we're down to the next to the last class, you guys. You're going to miss this, right?
Or so much.
Yeah.
The midterm class with you, Rick, so I won't miss you.
No, this is probably true. Yeah. I think that's going to be an interesting class. Who said that, by the way?
Me.
Good old Fred.
Fred, yeah. Who else is in that midterm class? Just let me see by a hand. Couple of you. So I've got a guy named Jens Yoon, who's a graduate of our program and is working with an investment firm in Norway that's going to be co-teaching that class with me. And it should be a very good class. I'm pretty excited about what we put together. Well, guys, any questions that you have about something other than the valuation case assignment that you want to address at the moment before we launch into the questions on the case or cases?
How's the test going?
You know, my guess is that either later tonight or by midday tomorrow, I'll have the scores out.
What's the overall idea
How
on
they
it?
looking? Little curve?
Yeah.
Curve action.
So,
That look on his face.
Yeah. He's like, let's just say a few.
So some of you provided impressive narratives and commentary. Some of you, I think needed to spend more time participating in the course and its many different elements. I'm just going to leave it at that at the moment. And honestly, my guess is that your grade, your score will not be terribly surprising to you. I think that as I've been going through these, I think that those who have been more participative, more engaged, and have probably felt like they've had a better sense of what we're doing, in fact have. And those that have been on the fence and have maybe not had as much of a participation commitment and such, it was apparent in reading some of the responses. And I'm not talking about just participation since we've gone into our virtual environment, but I'm talking about from day one. Okay, so I don't think your grades are going to be very surprising to you. Anything else?
Are we cool if we just take off the course essay at the end? Is that cool? You just kind of.
I think there would be some elements for you that would be really cool about that, Brandon.
I think so too.
But I'll just take it from the standpoint of something I think you know pretty well, and that is there's 5 minutes left on the clock. Is it okay for you to decide to leave the floor?
You know, it depends. If we're winning by 20, might as well.
And in 5 minutes, that opposing team with no opposition can score a heck of a lot of points, brother. So I'll just let you make that decision all by your lonesomes. You guys are funny.
Sounds good.
And
hey, you remember Rick's last thing of how you would do well, Brandon? That's probably applying to that too.
So well, in that case, it sounds like you are ready just to ask some questions because you're mostly just messing with me now And that works just fine for me, by the way. So let's start in the same order that we're going to do these presentations on Wednesday. We'll start with
Rick,
yes.
sorry, I have just a quick question about the valuation case. Are the companies, so they're real companies, right?
Yeah, we're gonna back up. And my question, my offer to answer questions was anything other than the valuation cases. Because you're about to ask me a whole bunch of questions. In fact, Martin, you're part of Almaden Tech, so you guys are up first.
Yeah, like
Okay,
the question of Martin is like kind of global for everybody, I guess. That's
Okay.
what you wanted to
So go ahead and ask it
it's
then.
just, so they are real companies, but you changed the name, right? It's not the real name of that specific company.
Yeah, so let me be more specific. So Almaden Technologies, Cerebral Software, and Jensen Agribusiness are real companies, and the numbers you are dealing with for those years in which you're dealing with them are real numbers. Now, you might find that there have been some changes in numbers as you ask me some questions, okay? That's
because
possible.
when I Google it,
Yeah, but they're not the real names, Martin. They're not the real
okay,
names.
that was my question. Okay.
Yeah, so I will tell you that Almaden Technologies, Cerebral Software, and Jensen Agribusiness are companies that I know extraordinarily well, and these are not the real names, and nor will you get the real names out of me. When I sold my private equity firm, I signed a non-compete and a non-disclosure agreement that would bind up a small army, and there were enough zeros at the end of the deal that I'm not risking any of it. But I've gotten permission from these companies to share this level of information, and I still have an active, a very active relationship with those three companies. Chino's, on the other hand, is not expressly a real company, but it was a fairly real case developed by a guy named, oh gosh, his last name's escaping, David Beard, who's a finance professor at Georgia State University. And the Chino's case was actually used by the 2018 business valuation team because it was the case that we were assigned for that year. So, and it loosely follows some of the activity in the merger between Joseph A. Banks and Men's Warehouse. Loosely. Okay. Good question. So now I'm going to bring up on my screen some of the materials here so I can make sure I'm not going too far astray. And we'll give you guys on the Almaden Tech team an opportunity to ask some questions. And you're welcome to start asking them at any time.
Oh, wait. So Rick, the first question we had for your company is about the NOPLAT and your valuation you did. We saw that you're using NOPLAT as the free cash flow in your valuation. So we were wondering if it would be like why you did that, and because it makes more sense for us to use a real free cash flow since the NOPLAT is not taking in consideration any cash outflow. So
yeah.
Why do you use
so that's an interesting question, Alex. So and by the way, I also will tell you that I will be representing all four of the companies today. We won't actually have any company officers with us, okay? And I think I can do a more than reasonable job of that, given how well I know the companies, and with Chino's, there is no real officers, of course. So with that said, I will tell you that that Almaden has virtually no debt, and it has very, very few items on this that you would consider on a balance sheet to be fixed assets. So NOPLAT And you can kind of think of no plat just as a tax-adjusted EBIT. And the only difference between that and free cash flow is depreciation, but without any real fixed assets on the balance sheet, there is no depreciation, not really, right? And there's no change in fixed assets, which is the core of net capital spending. So I'm not sure that we could articulate a meaningful difference between no plat and what you guys would think of as free cash flow. Now, you might want me to forecast out the balance sheet, which would include forecasting out cash and such. But I'll tell you that that we didn't do that, and you'll find if you go on into the advanced valuation course or any other more advanced valuation metrics, that it's hard to forecast out a balance sheet, especially when you don't have a lot in the way of fixed assets. So does that answer? Does that help? Does that answer your question?
Yeah, kind of like, cause so how is it possible that you don't have any fixed asset? I mean, like,
Well, we lease our offices, and if all we really have is computers, servers, and in the years that we bought those, we bought them. We were a smaller business at the time, and we were able to expense all of those items on the income statement. You might know that up to $100,000 in expense or an expense of an item, a small business can expense that rather than capitalize it. So we expense them. The only thing I guess that we probably should consider capitalizing would be the output of the R&D. The drones are manufactured through a contract manufacturer, so we don't actually own equipment to manufacture them. Now we own the technology, we direct all the activity, but rather than have that hard cost in equipment, we've gone to a contract manufacturer. And interestingly enough, have you guys done the Leland manufacturing case yet? Or is it you did Leland manufacturing, didn't you?
Yeah.
Okay. Leland
Sounds familiar.
Manufacturing is the contract manufacturer for Almaden Technologies. So it does all the manufacturing for Almaden Technologies. Well, not all, most of it. So we don't have any need for fixed assets. You might argue that the patents that we have are assets, but those would be intangibles, and we haven't gone to the point of trying to identify their value. And so I guess you guys could help me figure out what the intangible asset value would be, given that the balance sheet would be tangible assets plus intangible assets equals liabilities plus owner's equity. So you might be able to help us figure out what the intangible asset value would be.
Yeah. And about the same part, like when you did evaluation of your company, we saw that you assumed a WACC of 20% and an ROIC of 16%. So we wonder if you just calculated or if you kind of assumed one compared to other companies, or like how did you come up with these numbers?
Yeah, that's a really good question. So given that there's no debt on the balance sheet, so what we would think of as cost of capital, and we listed as WACC here, really is more an issue of equity, right? Since there's no debt. So it would be preferred and common equity, and the target return for the investors that own the common is 20%, and so they require, it's not a target really, it's a requirement. They require at least a 20% return on the common shares. and an overall return of 16% on invested capital. Now, I will tell you that to date, we believe we've returned more than that. So that's more of a required return, but I'm not sure the required return, if it's a reasonable expectation of return on an investor's part and a cost of capital are any different if there's no debt. Now, if there's an unrealistic expectation of return on an investor's part, then that might be different. And in this case, the company is yielding about a 16% return on capital. But that's not good enough for the investors because we do have the investors do have a modestly active role in the overall operation of the company, its vision, and such. So there's more than just cash that was invested by the investors.
Okay, because like about the ROIC, since you don't have, as you told me, a lot of fixed asset, shouldn't you have a higher ROIC? Because for now your ROIC is lower than your WACC, meaning that if you want to grow, you're gonna like lose money.
Yeah, my guess is you're thinking about this from a invested capital standpoint of from the operations approach, right?
Yeah.
And I'm going to tell you that, remember, there's a second approach. Do you remember what that is?
I get it.
Financial.
Yes, it's the finance approach, and where we take the total equity of the total debt. So we aren't restrained to this fixed asset deal that you're concerned about.
With that one though, Rick, don't those usually yield the same? Like, isn't that kind of a way you can check?
Well, they do. They do, which means there must be some value in intangible fixed assets, right? And as I indicated a minute ago, we hadn't gone to the point of putting a number on that.
Okay. But like, so do you, it's kind of weird that you have like your cost of capital is higher than your return on investment. And so why are you planning to grow if you still have, if you have a lower return on investment?
That's a good question. So again, think of that, and it's noted as WACC here. It should have been noted as cost of capital or capital expectation. You need to think about this more from the standpoint of an investor requirement rather than an actual cost, and in part because there's no debt. I mean, we as a company, we've never written a check for for that return, if you will. But the investors, are satisfied. Well, and maybe I can help you understand their satisfaction. You're looking at, I think it was 2018 revenues of 3.2 million, right? And there was a forecast hoping to get to 4 million something in 2019, and I think it was 5 million something in 2020. Well, 2019 revenues were $6.8 million. So we beat the forecast by about $2 million. And we posted an operating profit of 1.2 million. And we reinvested all of that and about another 800,000 into R&D. So you need to try to not get too hung up on this invested capital thing when there's no debt and there's not a lot in the way of fixed assets. This becomes an issue, and the whole capital question becomes an issue of investor expected return. And you might say, well, if you're doing a CAPM sort of RE equation to give us what our WACC would be, well, that's going to have to do something with the investment markets, right? Because that's going to be heavily flavored by RM and beta. And you can appreciate for a little drone company that's growing like mad, but still a fairly small company with less than $7 million in revenue last year, the beta would be high. And so, yeah, arguably the capital cost and required return are kind of high compared to the ROIC, but we're investing heavily in R&D still. So I think we're okay. Okay. So what else do you want to know?
So then, do you have any plans for the future? Because what you're saying right now is that you have a 5 million credit line, and that you expect to pay it off every year. Do you have any long-term plans of acquiring long-term debt in a different way?
Yeah.
And if you do, how much and in what way?
So we actually don't have a $5 million credit line. In fact, I think you're taking that from one of the last paragraphs. We would sure like one though. And if we had a credit line, that would be suggestive of us having some debt, but we don't have any. We'd sure like to find about another $10 million of equity investment. So that the last paragraphs I think you saw in this are talking about us wanting seeking an equity investment against a valuation and seeking a credit line. We actually haven't done that, so we're looking for that. And so the question might come, well, how are we bleeding? How are we spending more money in R&D than our operating profit? And the answer is that we're in a cash bleed. Our cash, we have an uncomfortable amount of cash on the balance sheet, only about $500,000 of cash on the balance sheet. But we're bleeding cash because we have been using some of the equity that was infused into us with our last equity round.
But yet, why seeking a credit line instead of long-term debt?
Oh, because we don't necessarily want to use all of it, and we just need it for ins and outs. So we don't think we need long-term debt, Martin. Not at this point. Not if we get the. We have a good equity partner. We'd like to add to that. I don't think we need any real debt at the moment. But there are times we need some extra cash, but just for 30 or 60 days. Because of selling cycles and such.
Okay. And also, we noticed that your expected long-term growth is really high. It's 10%. Why do you believe it could be that high? I understand why your explicit period might be really high, like 35% for one of the products and 75% for the other, but still 10% on the continuous period seems pretty high.
Well, I guess you might. I mean, that's kind of for you to decide. But I'll tell you that my guess is over the next 3 to 5 years, our actual growth will exceed 100% a year.
But you say in the next 5 to 6 years?
Yeah, the next 5 years or so, our actual growth will exceed 100%. So
on a yearly basis or in total?
Pardon me?
Did you mean you will exceed that growth on a yearly basis or
year over year for each of the next 5 years?
Year over year.
Yeah. I mean, if you look at it, we exceeded that in last year. We went from 3.2 million in 2018 to 6.8 in 2019. So we exceeded that. And you know, if you think about this, the consumer drone business is non-trivial, but it's growing rapidly. But our big play is not in consumer drones. Our big play is in these heftier drones, where we've got you know, some huge contract possibilities.
So, when you talk about you came from 3 million to 6 million, which number are you talking about? Because I can see them on the documents we have. Because like for us, your last revenue is 1.8 million.
Well, I believe I'm showing you a year zero, which was 2018, at 3.2 million. If you go down to what I think is the last, what I think is the last of the exhibits, you have year -1. Well, that was 2017, and then year zero was was year 2018, and then we had some growth to come into 2019. That was our year 1.
Okay. And so like what you said is that in 2019 you had a 6 million revenue instead of the 4 plan?
Yes. Yeah, in 2019 we had 6.8 million in revenue. And most of that revenue growth came from the Quicksilver line. So we actually started selling Quicksilver units earlier than we expected. Say again, Alex?
You already started to sell the Quicksilver one?
We did.
Oh.
It's part of how we beat our revenue expectations.
Okay.
In fact, I think that the Quicksilver unit and revenue expectations you guys are seeing here is probably it's very low. It's very low.
So and could we have your like actual documents? Could you send them to us?
Well, no. But I will tell you that all you have to do is extract the 2019 or year 1 on the document you're seeing. All you have to do is extract that and know that the mercury units remained about, or we had the growth in mercury about that we expected to. It's the Quicksilver that just took off. And so if you know that our revenue is 6.8, you can figure out how many units of Quicksilver we did, and our cost structure on them is about what we originally anticipated. It's about. So you can see they're not cheap. These are not, the Quicksilver is not a consumer drone, right?
Yeah.
It has a decent payload. It's got a decent range, and it's more for commercial utility.
But talking about this, there's something weird in the table because it says, so let's see let's look at Mercury 1.0. It says that above when it hits 3,000 units, the cost per unit drops to 675. But when we look at the year 1, it's still 800. Why? Because we hit the 3,000 units and we should be 675.
Yeah, that's a good question. And my sense, and it's only a sense on this, Martin, is that that's kind of an average cost. So we didn't get that better cost until we breached 3,000 units. So for the better part of the year, we were under 3,000 units. We were paying a higher cost. So my sense, that's probably more like an average cost, I think.
Okay, and so it would be the same for Quicksilver because it's the same when it hit 1,000 units. I think it drops to 6.
Yeah, and
or 2,000.
I think you're going to find we've already exceeded 1,000 units.
Yeah.
Okay.
So we've only got a few more minutes for your group to ask questions because we have 4 groups here.
We also have a question about like so when did the company when did you found the company? And because we wonder so if you converted the preferred stock of the 5 million into 5 million in preferred at 15% dividend rate, or if you converted it into common stock based on a $35 per share valuation.
Okay, hang on just one second. So the answer to the first question was 1998. But you got to know that the company that was founded in 98 and the company that exists today have precious little resemblance to one another. I mean, you just loosely think of that company in '98 as being a technology company, and the only real similarities that exist between the two is that there was a little bit of battery technology going on there, and there was some camera technology. That both of those exist in the drones today, but they're not. But in '98, I don't think they knew that this was going to become a drone company. Maybe they did, but and so the to answer your question about preferred and common, there still is preferred and common on the balance sheet, but the preferred stock is preferred in voting rights only, and so it is founder stock, if you will, and so it has a 1-to-1 value, if you will, and 1-to-1 dividend opportunity for the common. So there's functionally no preferred on the balance sheet anymore. It was all converted to common, but it's got a different voting classification.
Okay, because it appears that you have around 36% of equity of what you put on the first table. You said that your equity divided by V is equal to 36%. So is it your common equity and
I'm sorry, where are you seeing that?
On the first table, just when you calculated the cost of equity, RE, right after that.
Yeah. Well, and that would now be 100% because this is now all effectively common stock.
Okay.
Because the conversion of the preferred has now taken place, and it's all in common stock now.
So V would be equal to equity, right? To E.
Yeah, E and V are equal to each other now, which is why RE is the only viable cost of capital, and you can think of that as the 20% investor expectation.
Okay.
So we need to go on to the next company just because of time here. Right. If we have a few minutes to come back to you, we will. But there's a more important question that you guys aren't asking here.
Yeah, I mean, I was about to ask about the 15 million valuation, current valuation.
Yeah, that's not the important question. So you want to know why we had that huge revenue spike, and you want to know why the investors were willing to convert to common from their preferred position. You've got a little bit of information about some contract possibilities, but I don't know that you have an awful lot. Do you want to ask any question with respect to where did all this additional business come from?
Yes.
Thank you.
Yeah.
Thank you. So we're still in the hunt and running with Amazon and UPS for drone development, for possibly being able to land packages on people's doorsteps. I don't know. That still seems a little bit Buck Rogers to me. I think that's a ways out still. But there isn't a national park in the country that hasn't been mapped by our drones. Not a one. The Forestry Service uses our drones to help with fires, and the California Forestry Service, after a couple of years of devastating fires, is now using drone technology more than they ever anticipated they would. So the Forestry Service, the National Park Service, and the various state firefighting corps have become huge customers of ours. Add to that cattle ranchers. And so and cattle ranchers use both the consumer and the non-consumer drone, but we've had some really nice market development there. I got to tell you, I dig this company. And I'll tell you one other thing about it, and then we got to go on to another. Here's how creative the engineers and founder are for the company. Somebody thought, well, if cattle ranchers are using the drones and they're using them to keep track of where the cattle are, I thought, well, could you use a drone to herd cattle? We used to do it with cowboys, right? Could you use a drone to herd cattle? Well, as it turns out, you can. You can use them to find cattle that are up in little valleys and draws and down canyons. You can use it to herd them. And because all they need is something to come in and make noise and spook them to get them to run a certain direction, right? So somebody that is able to sit in their ranch house or in their pickup truck, in Montana, can be herding cattle from wherever. So that's kind of cool. But, and that's taken a little bit, mostly, just keeping track of where the herds are. And then somebody decided, well, if you could herd cattle, can you brand them with a drone? So instead of a camera, can you put a laser on the nose of one of these things? Well, that didn't turn out all that well. So we won't do that again. Okay. Anyway, this is a cool little company. So I think that we're going next to Cerebral Software, which I dig also. And let me bring up the other item. Okay. Bear with me while I get myself set here and you guys get yourself ready to ask some good questions. So who wants to start asking questions with respect to Cerebral?
I'll start.
Cool.
So just like an introductory question would be like, what are you looking for as a company? What are you looking for out of this valuation? Do you have any specific questions that you want us to answer?
Yeah, we need to have a better sense of what the current valuation is, Micah, because we're about to do a debt or equity raise.
Okay.
We need some additional capital.
Okay.
Yeah. So we got to find out what now. Also, Sari Gupta, who is the key employee that was indicated from our Philippines operations that would perhaps be the leader or the core of our Bangalore, India operations. Sari needs to be given some stock option. And I need to close the window. There's a whole bunch of noise outside. Bear with me. So Sari needs to have some pretty aggressive stock optioning so we can evidence a substantial ownership in the company by an Indian national. It's the only way that we are able to realistically meet the regulatory guidelines in India for foreign ownership of a company. Because India, they don't like foreign owners to come in and own companies operating there.
Okay, so you need to make it possible for her to be considered an owner?
Yeah, we do. So we've agreed to give her some pretty substantial stock options for the Bangalore operation. And so we'll actually ultimately have to account for both operations separately, but they'll all fit under one umbrella for Cerebral Software. We didn't have that problem in the Philippines, but in India you do. They have capital controls and such. So we need to know the valuation because we need an equity raise and because we need to know at what pricing and such the optioning has to take place for Sari so we can make sure that we stay safe with the Indian regulations for business ownership.
Okay, so looking at it now, you've got kind of the owner with a 40% stake, and then you've got 2 employees with 2%, and then the rest is owned by a private equity firm.
Yes.
So like, are people, I guess, in the business now willing to give up some of their ownership so that you can open this branch in India?
That's a really good question. So the answer is yes. So the shares that Gupta will have optioned to her will come jointly from the founder and the private equity firm, and not from the two other individuals who each own 2%.
Okay.
So there will be dilution for the founder and the private equity firm.
Okay. Okay. Thank you.
But she's not going to pay for that, right? They're just basically going to say, because you're helping us expand, we'll give you some of the stock options. She's not like giving the equity, correct?
Yeah. So that's right. That's right. So Gupta has already brought substantial value to the company. And we, A, want to recognize that in some stock optioning for her. And B, without Gupta, we wouldn't be expanding into the Indian marketplace. The Indian marketplace is talent rich for the wages that are paid. Average per hour wage of a programmer, I mean, a well resourced, highly educated programmer is about $5 an hour in US dollars. And we pay better than that. We've paid Gupta better than that. But the fact of the matter is that that when we go into that, as we've gone into that marketplace, and you should know that some time has passed, we have gone into that marketplace already, but we aren't fully fleshed out, that without Gupta, we wouldn't be doing this. And this is a good thing.
Okay, I've got a question about your revenue. It seems like there's a spike in 2015. So I would say, I mean, you're probably averaging around like 13% in the 5 years that were shown. Well, if you take out 2015, but 2015, you showed 21% growth in that year, which is huge. And so I was wondering if you know the cause of that.
Yeah, so in this case, at that time especially, the company was small enough that picking up even one additional meaningful contract was big. So the state of New York contracted with us that year to develop essentially the backbone of what would become their state voting infrastructure. So the state of New York, as with many others, will ultimately go to voting that's completely digital and online. And so much of the state voting infrastructure has been changed in the ensuing years, and that was the year we picked up that contract.
Okay, so then I just calculated your average growth from the 5 years that were shown, and I'm getting about a 15% average growth rate. Okay. Is that reasonable to continue that forward in the next few years, or is there a reason to think it'll be higher or lower?
Well, that's a good question. It's not reasonable to believe that we will maintain that pace. The investors are not satisfied with that pace, nor has the founder become satisfied with the pace now that they've been better resourced with some investment capital out of the private equity firm. And we're using a lot of cash to make some of these investments. We burned a lot of cash going into India, and as well as having brought on some additional people in the U.S. to help market our services. But the upside to that is contracts with 3 school districts or 3 state school systems out of the 50 that exist. And then an expansion of that New York State contract and some wicked fintech apps. So I think where you saw 2017 revenue coming in at about 7 million, 2019 revenue tops 12 million.
Wow. That's crazy.
By the way, somebody asked a question about a 10% long-run growth rate a few minutes ago. Did that have to do with Almaden?
Yes,
Okay.
that was me.
And I'm going to come back to that for a second because what I'm about to say applies here as well. I think we as valuators would say that that's a crazy perpetual rate, right?
Yeah.
And it is 10% is a crazy perpetual rate. Never, ever, ever use it. But if you've got a company that's growing 100% plus today and will for some period of years, and then you take that 100% plus growth and then start to water it down to maybe only 50% and then 20%, and then, you know, some reasonable percent, can you average 10% in perpetuity? Well, numerically you can't, because perpetuity goes too long. You're going to converge on a very low growth. So I think that a 10% rate probably is an unrealistic rate to think about for perpetual growth. But when a company says long-term, they're not thinking like you and me. They think long-term's 5 and 10 years. A company doesn't think in a perpetual sense. We have to think in a perpetual sense.
So basically, we have to change growth.
I would think you might. I think you probably have to increase it in the near term, and this goes for Cerebral as well. You have to increase it in the near term and decrease it in your long term or your perpetual G.
Okay.
So who all is in this group? We got Micah and Jaden. Who else?
Me. I have a question about the private equity. Since they hold like a large amount of the percentage, what kind of like decision making do they have within the company?
Good question. More of an advisory or a board role, Annie. I will tell you that the company doesn't make an important decision, and when I say the company, I mean the founder, doesn't make an important decision without consultation with the private equity partners that they are aligned with. But it's really more advisory and from a board position. There's not an active role. The firm hasn't put somebody inside of that company.
Why was the founder willing to give up controlling interest of his company to a private equity firm?
Because he got a lot of money. and I think two reasons. I think he was paid well for doing it, especially when you consider the amount of money that he put into the company and that he invested in the company over the years. It was very little, because it's really more a personal services company, right? It's a bunch of programmers. The capital investment is computers, and most of it's done on laptops and connected with cloud servers, etc. So he did very well in terms of his personal return when that took place, and so I think that's part of it. Part of it is he's older. He's 63 years old this year, and realizes that at some point he'd like to have some exit, and he wanted to be able to enjoy some of the fruits of what he built. That's why he was willing to accept some of the money. But then I think he also trusted the people he was dealing with, and believed that their interests were well aligned with his.
Okay.
And then, so I have some questions about determining the various costs of capital. So you gave us some in-depth, well, probably simplified, but either way, you gave us financial statements, and from that, we can use some less preferred measurements for what your cost of capital would be. We could take the common dividends you've paid and divide it by the amount of equity outstanding, as well as we could take the interest and divide it by the book value of debt. Do you have would you have anything that you would say to help determine better rates of opportunity cost of capital?
Yeah. So let's look at debt for a minute. How much information do you guys have about debt? You've got some.
Now, we don't have enough to determine the market value of bonds.
You're right, you don't. And so when that's the case, you don't do so. Okay. But you do have enough to identify what an approximate interest rate would be, because I think you have an interest expense on the income statement.
Yep.
Right. And you have a book value of debt on the balance sheet. So you should be able to infer a average cost of debt on a book basis. And that won't be meaningfully different. I can tell you that the credit line, which is expanded at this point, I think it was about $450,000 used on the credit line as of 2017. There's currently about $600,000 that's outstanding on the credit line. All the other debt is pretty much the same as it was, and that $600,000 is at 7%. Now the credit line and the bonds are also held by the private equity company. So the private equity company bought the bonds, issued the bonds. So this was a debt and equity transaction. And the credit line is at 7%. It's $1 million credit line, of which they've used 600, but their interests are so well aligned that the firm would likely extend more if it seemed reasonable.
Okay. And then on the equity side, you guys have been doing consistent $200 dividends. Has that changed? Is that going to change in the future, or is it going to stay at that $200 range?
So $200 dividends?
Well,
I'm sorry, you mean $200,000?
Total, yes.
Yeah, okay, got it. It just confused me a little bit. Yeah. So I would expect that will remain constant as long as the founder is also actively involved in the business.
Okay. And then so you mentioned, just kind of as a side comment, that since the time we've had, you've started to go into India, and that has depleted cash significantly. Currently, the balance sheet shows 1.9 million in cash. Has that changed?
Yeah, we're down to less than $500,000.
Okay. Wow. That is okay.
Yeah, we've hired a lot of programming talent, both in Cebu, Philippines, and in Bangalore, India. We've hired two key, I'll call them account managers. So their exclusive role is to find development contracts for the company, and they've done a great job, as is evidenced by the increase in revenue, right? But a lot of the, we can talk about an increase in revenue, but it takes a lot of effort to get this stuff going. And then there's been a lot of travel back and forth to India and the Philippines. The founder spends 3 weeks out of every 2 months in the Philippines and now in Bangalore.
Wow.
And by the way, that's how he's able to do this. There are a bunch of companies have tried to do this kind of thing. Have a domestic firm that has captured foreign labor, cheap foreign labor, and then run it from abroad. And few of them are able to do that. This guy, his working hours are when most of us are asleep. So he starts his work day at about 4 or 5 o'clock in the afternoon, and then works until way into the night, because that's when his foreign employees are working. And then he spends 3 weeks out of every 2 months over there.
Wow.
In terms of him, he seems like a big asset to the company. Do they have any way to kind of protect that as he's getting older and traveling all this time? Is there some sort of, I just feel like there's some risk involved in
Peter, you have hit on the one most concerning aspect of this company. He is arguably irreplaceable. As I said, many have tried to do the kind of thing he's doing and have not been able to succeed in doing it. Part of the reason to incent Gupta, as the firm is because she appears to have similar talent. But I mean, and beyond that, part of the transaction when acquiring part of the company was a huge key man life insurance policy on him. So if he gets taken out, well, frankly, by anything, but the concern was some foreign-born illness or air travel, disaster or something like that. If he gets taken out, then there's a big life insurance policy on him, but it's not big enough. He's like I said, he's 63 years old, but he's a big boy, and I'll bet you he tips in about 280-ish. Okay, so he's a Big Mac away from a heart attack. He's healthy, he's remarkably healthy. His parents are in their 90s, okay. But that's the worry. That's the worry.
For sure.
And then, do we have any idea on a way to determine a market value of the equity? Because it's relatively low on the balance sheet.
In fact, I think in this case, that's part of what's needed. So you're going to do a valuation here. And from that, you can then tell us what the market value of all the equity is.
Okay. Okay. And then one final question I have is there an idea of the required return or the rate that equity is requiring or demanding?
So the same private equity firm that owns a substantial part of this owns the substantial part of Omnium Technologies and has the same 20% expectation.
Okay, I have a question because we've kind of been left in 2017 with this expansion into India.
Yeah.
And I'm wondering now in 2020, is this complete or are they still working on it, or are they expecting to now see an increase in revenue because of this expansion?
So, I think I told you that the revenue was up around 12 million, if I remember correctly. Micah, a lot of that is not because of the expansion. That's mostly because of taking on more contracts and clients, but their needs have been filled by having expanded our programming manpower, both in Cebu as well as Bangalore. So yes, the Bangalore operation is up and running. I think it's got 17 programmer developers sitting there, and probably flushes out at 30-ish, maybe more.
Okay. Yeah, that's like, it does say on here that their plan was to have about 30 programmers there.
And has this changed at all the ratios of expenses to revenue? Has that increased?
I calculated those and they're super consistent.
Yeah, they're pretty consistent and they're remaining fairly consistent.
Okay.
I'm calculating the enterprise value from a relative valuation. Can you give me the most recent revenue?
Yeah, I think it was 12 million too.
12 million.
And I don't remember off the top of my head what the EBIT is, but as Micah said, it's been pretty consistent margins. So
yeah, I can calculate it.
Yeah, you can calculate it pretty simply.
Yeah.
What else? Well, this is a cool company. The FinTech and hang on, the architecture that this is built on, blockchain, excuse me. The blockchain technology that this is all built on is evolved rapidly. The voting systems that are under development, the work that's being done with those 3 different states' school systems is all on blockchain technology. And these guys have a pretty good understanding of that. If you know anything about the blockchain, you know most of us think about blockchain and cyber currencies or cryptocurrencies. But really, blockchain is just the architecture cryptocurrencies tend to be kept track of on and trade on. Otherwise, you know, they're 2 separate issues. There's an innovation to blockchain called Spider Networks, Spider Tech, that is underway, and it's just kind of like blockchain 2.0, if you will. And these guys have a pretty good handle on that. I think there was a question in here as to where the company was located. I think it's stated in the case, but it's Orem, Utah.
And most of his like clients or contracts are in the U.S.?
Yeah, good question, Annie. 100% of them. They're all domestic. So that also means the company doesn't have any foreign currency risk. So we pay our bills in foreign currency, but all of the revenue is in USD.
So why is it such a hard space to enter into?
Pardon me?
Why is this such a hard industry to enter into? It said most entrants fail.
Yeah, it's actually not hard to enter into. It's really easy to enter into. There's a few barriers to entry, right? Yeah. But it's hard to keep foreign programmers productive and engaged and moving forward when you're sitting in your office in your Orem, Utah.
Okay.
Okay, and it's why he spends 3 weeks a month there. Or 3 weeks out of 2 months there. Most people won't do that. It's why he works a work day that most of us would find intolerable.
Okay.
His personality is such that it works for him. Most people that have tried it have simply wanted to, for lack of a better term, exploit the foreign labor. He did something, and this will have to be the last thing we say about this before we move on to the next company. He did something that for about half a moment, the investors argued with. I think I told you that the average wage is about $5 in US dollars in these 2 economies, the Philippines and India, and for programming talent. But Cerebral pays $9 an hour.
Wow.
And the employees are not on contract. They are full-time employees. They come to the Cerebral office. There's a management system. And so that extra $4 an hour buys a whole lot of loyalty. And most people don't do that. Most are just trying to exploit the $5 an hour or whatever it is cost. The management or the private equity firm wondered about the wisdom of this until a discussion with one of the earliest employees of the company. Who said something that was touching, and that was, and she was asked why she was so loyal to the company. Why had she stayed with the company almost since day one? And her answer was, before working for this gentleman, the founder, she had a job, but ever since she came to work for the founder, her family eats every day.
Wow. Right?
I mean, it almost makes me cry just saying it now because I know the person. But her family eats every day now. And on $5 an hour, you can't provide for a family. So yeah. So hats off to the founder, and it just tells you a lot about the company.
Yeah, for sure.
Rick, can I ask one quick question, then we can move on?
Okay, go ahead.
Are we expecting the raise in the $1 million raise in debt or equity to change the cost of capital structure?
Good question. I would think not. So let's go ahead and talk about Chinos. I think that's Will and Megan and Paula. let me bring those up. And I will apologize. Chino's is the one that I can give you the least interesting information on because it was a case developed by David Beard. But having worked with the valuation team and such, and knowing something of what's happened in the interim, and I'm going to give you some hypotheticals in this as well that'll be interesting for you. We can have an interesting story here. So who would like to start off the questions?
Yeah, I can start. Our first question would be, what do you see or expect your long run growth to be from the 5 to 10 year range?
Good question. So the numbers you're looking at, I think, were active numbers as of 2013. 2013 was the last estimate that was projected from 14 to 18. But we do know about 2019 revenues now. 2019 revenues, by the way, were just over $750 million. Okay, 2018 were projected to be just under 750, so that's 726. But those were projections; those were just estimates. But now time has passed, and in fact, this combined entity has had a terrible slump. Sales, I think, or total revenue, I think it was in 2016. Finally slumped to less than $400 million. So 2011, 635, 2012, 585, 2013 were projected at about 558, so continual down, and then they were projected to start rising nicely in 2014. Well, they didn't. They continued to fall till 2016. Combined revenues were less than $400 million. So this company is in trouble at the time. And so the transaction that was being considered with ATL Capital and such on in your initial story, that transaction died on the vine. There finally was, though, taking that company private. And the company today has a new CEO, James Frunter, whom I believe was the CFO at the time, is now the COO. And their company has hired a new CFO for our alphabet soup here. But at the back of this, Wantia is still involved in the company, as is Max. Wantia is no longer the CEO. Max is a functionary. The Down East, the rapper, is no longer associated at all. In fact, that whole product line has been shelved. It was not very well executed. The company shrank, tremendously. And if you look at the company today, I mean, really today, coronavirus today is fighting for its life. It's got most of its sales. In fact, in these years, all of these sales were in-store sales. The company had no digital footprint, none. Even in 2015, none. And so sales continued to decline, right? And today, all of their brick and mortar stores are literally closed because they're all in malls, and every mall in the country is closed. Now, how that'll change and what it changed from back in January is questionable, but brick and mortar men's clothing, without a digital footprint is not a successful strategy.
Well, that was another question we had is, would they consider doing any direct-to-consumer marketing, or why don't they have a website, those kind of things?
So that's a great question, Megan. In fact, the majority of the increase in revenue since the trough in 2016, the majority of that has been digital. So the company does have a very robust website today, and it actually has a preferred shadow seller through Amazon. Do you guys know what shadow sellers are?
Is that when you acquire things and then you don't actually have them in your physical possession, but you then sell them and then send them on?
It would certainly include that, Noah. So in this case, it's Chinos has, under its real name, but Chinos has a digital footprint, and so it's got its website. Brandon can go order clothes off of its website, and it'll be delivered to his house, or he can find Chinos clothing through a seller at Amazon, and that seller isn't Chinos technically, but in reality it's Chinos. It just uses a different architecture. So it's got sales through its own website, and it's got sales through Amazon. And those two distribution conduits have taken sales from about 400 million to 750 million. So that's huge. In fact, the very life of the company. But the company was worth almost nothing when these guys came in.
So I guess the question is, for the future growth, going back to that, is the increase in revenue based on this new digital marketing, or are they still kind of just hoping that they're going to grow because the economy is going to grow, or kind of what's the plan?
I think that's a really good question, Megan. And absent our corona crisis uncertainties, because who knows where we're really at, but absent those, I think you can expect at this point that this company would have a similar growth trajectory to men's casual apparel as a industry classification. I think that there's nothing about where they are right now that would tell us they should outperform the industry or underperform it. They advertise a fair amount. They've got good quality and good looking stores and product lines. They've finally gotten their arms completely around digital, so they've seen a big move from that. But I think that curve flattens out. I think they go with the industry. I think we've seen the big pop. In fact, to be perfectly honest with you, my expectation is within 2 years, this company should be ready for an exit. It was taken private, it should be ready for an exit.
And kind of before we ask, going along with that one, backing up a little bit, I read in there the information we were given is they were looking to move and expand into Canada with their Boots
Electric.
And now having more information, are they in Canada with that? Is that part of the company now?
It's not part of the company now, but yes, they did. That was part of Max's brainchild. So I want you guys to think about this for half a second. So Max thought that this company could be bought for 5 times earnings, Boots Electric, right? And well, if you can buy it for that, you're buying its cash flow. So if all we're doing is paying dollar for dollar to own the company's cash flow, why do that? But they did it anyway. And in Max's foresight to not allow the company to go digital, he and Juan Tia not allow the company to go digital, they now exported that winning strategy to another country. Hence, the company's total revenues fell to $400 million. So Boots Electric was shoveled off to another company, what little bit it had left, and it's not part of the strategy.
What about the leather jogging shorts? Hopefully those didn't come to fruition.
Yeah. Now, again, I don't know if it really was leather jogging shorts, okay, because there's some fictitious in this deal, right? I don't know if it really was leather jogging shorts or simply something else that was as ill-conceived, okay? But really, can you imagine?
No.
Thank you. Thank you.
But I guess so, more serious question. The valuation, so you said they went private since the case, but one of our things was talking about their capital structure. And so if they did go private, does that mean that they're saving the expenses that it took to keep public?
Yeah, so the ATL Capital deal died because ATL Capital realized that they were offering way too much for the company, okay? And that the $12 stock price in the marketplace was terribly overvalued. So the ATL Capital deal died. The company saves, when the company went private, there was a lot of expense in that, of course, and the company doesn't have those expenses of public disclosures that they did, but in today's markets, a company of this size, there's still public disclosure that private companies need to make. It's just not as expensive and not as many of them. So yes, they've saved some, but it's not a big savings, not enough for you to think about articulating.
Okay.
Okay, and I'm wondering, like, they have the personal expense included in their income statement, and then when we do like valuation, should we add those back to the EBIT?
Yeah, and help me remember, Paula, approximately how much were we suggesting was being run through this company in the way of personal expenses? Do you recall?
They have like 68 million personal expense.
Oh, I think that's personnel expense.
Oh.
Hang on a second. Which is why I can't remember. You're looking at the income statement, right?
Yeah.
Yeah, Paul, that's personnel expense. That reads as wages and salaries. Yeah, 68 million in personal expenses. I want to do that, by the way. I want that to be mine. Okay. Yeah. So as a publicly held company, this company wouldn't have seen much in the way of personal expenses running through it at all. In fact, if there is, then that's grounds for termination. That can be considered fraud. So small businesses that are closely held, that's viable and reasonable. Publicly held businesses, no.
And also,
IRS will come in and just take you apart.
For the acquire of the boost company, do they like take the boost company's revenue into their forecast?
Yes, but again, it was disastrous.
Okay.
And yeah. So and I can't parse out for you, but one of the first things that was done by the new CEO and fronter, the COO, is as soon as they had control, they got rid of Boots Electric. Okay. It was ill-conceived as the leather jogging shorts, perhaps.
And then do they consider the long-term debt of that company as well?
What do you mean by that?
I think acquire a company, like they acquire everything for that company. So do the Boost company have any long-term debt?
I don't recall, but to the extent that it did, it's no longer relevant because it wouldn't be on anybody's balance sheet at this point.
Okay.
I guess one question is, do you want, as the owners of this company, do you want us to value it now or as in 2014 when they were public?
That's a good question. I've been waiting for somebody to ask me. So in all but one of these cases, you're looking at data that is from some years before, right? But I'm giving you information that's essentially bringing you to the current moment or to the end of 2019. And so you're able to extract with the revenue figures I'm giving you, and assuming we've got similar forecast ratios, I think you can extract some EBITs and you can move forward, you can get some cash flows, all this kind of stuff. That said, you're going to have to think about what were these companies worth maybe in January of 2020, and then you might want to give us some interesting commentary with respect to what might be happening with these companies today. And with that, you gave us these actuals of like 750 million in 2019 and everything for sales. Would that be provided for us? Because we have the projections based off of 2013 along with, so I would be very interested in receiving the 2016 because that is kind of when they were taken over, right? And they created their website, were able to go direct to consumer. Yeah. Would any of that be available to us so that way we could make a more fair valuation for the company? Only on what I can tell you, Will. So their revenue in 2016 was about $380 million. So it went down below 400 million. And that included Boots Electric. And which was a trivial part of it, okay? And so even after having gotten rid of Boots Electric, the company's 2019 revenue was just over 750 million. So you can take that 216 trough to 2019, hopefully not a peak, but certainly a movement upwards, and you can extract some pretty interesting numbers. You can see an average growth rate and all of that.
And when we do calculation on the tax rate, we got like 40% for their tax rate. It's like
yeah, but is that relevant, Paula?
Not really.
Yeah, it's not anymore, right? What's the state and federal corporate income tax rate?
Yeah, set right now.
Yeah, it's flat, 26%.
But I think we need that to calculate the multiple.
You do, but it's the tax rate. It is flat at 26%. We've never used the tax rate that could be calculated by calculating taxes paid divided by taxable income. We've never used that. We've used tax rate on EBIT, which today is 26%. We've used tax rate on taxable income, which again today is also 26%. There have been some years in the past that it wasn't that, but today it's that. So that part's become very simple for you.
So I guess now that we're looking forward from 2019, what factors regarding coronavirus do you think will affect the firm, such as, the stores closing, but now you have more direct to consumer? What kind of things do you think will be your strengths and weaknesses?
Yeah, good question. So I can tell you that it doesn't look like the increase in digital sales during this crisis have not replaced the loss of brick and mortar sales. So overall revenues are down.
Okay.
But then so are overall expenses, because all of those brick and mortar sale employees have been furloughed.
Okay.
So and you've got some numbers in here, so you can play around with that a little bit. The company had this company experienced this kind of a crisis a few years ago, would have been just done, right? But because of moving into the digital marketplace, it has some life.
And you don't want us to get into like the stimulus anything, right? They're over 500, this company, with all their brick and mortar stores.
Yeah, this company, if they applied, they shouldn't have.
Okay. And then my other question being, I saw one of the things that you were looking for us was to possibly even ignore any bid of being purchased. So with your guys' mindset, are you wanting an exit plan, or are you wanting to see maybe ignoring that if you think you could keep growing and making more money that way?
Good question. So I think personally that the company's future growth at this point is probably more a function of the marketplace. I mean, the innovations, if you will, in-store marketing refurbishment, going digital, etc. Those innovations have already taken place. It was bought for cheap when revenues had gotten so low. I mean, they were bleeding terribly at the time, right? So it was bought for cheap. So I think you can expect that any additional growth is just market growth. And so I think the company probably is ripe for some kind of an exit. And I would think that Fronter, who championed this whole thing, because they took it private into the hands of key employees and some private equity. But again, I need you to remember, this is all a great story. You guys have to come up with more story that probably is influenced by now.
Okay.
And also on the PDF, I think they said they have like 50 million debt and then 120 million equity, which is not like related to the balance sheet they have.
Yeah, so the debt still exists, Paula. So every dime of that debt is still there. And the equity, I think you're going to have to tell us what you think the equity is, but the equity that was there, that's all changed after the acquisition, after it was taken private. So to run a valuation and tell us what you think the equity is.
Okay.
And then I guess a question you wanted to know was, how do we structure the company to make the company, the Martinez family, and the shareholders happy? What does it look like now that it's private, and what kind of return are any shareholders looking for?
That's a really good question, and you're right. So Wantia and her family still own a very small percentage of the company. They own, I believe it's 5%. They got a little bit of cash when it was taken private, but only a little bit. There wasn't much left. I mean, they'd run this thing just about into the ground. I mean, come on, leather jogging shorts, the rapper Southeast, I don't know what that's about. By the way, rap is not music, okay? And then no digital architecture at all. I mean, Sears had a more successful strategy than these guys, okay? So there's very little left for Wantia and her family, but they got a little bit. The other shareholders got a little bit. The other shareholders are all out. Wantia and her family own 5% of the shares. And then the fronter and the group of private investors that he put together own everything else. And the debt still exists. So you don't need to think about that strategy anymore, but you might want to think about an exit.
So what kind of return would fronter and the other investors be looking for at an exit? Do we know?
That's a good question. I don't know, but Fronter and the other investors took this thing over for very little capital, because it was all but dead. It was all but dead, and they took it over for the debt. I doubt they brought more than $10 million to the table, over and above the debt. So you can use that, maybe 10 million. Okay. Okay, so let's move on to the last case. So this is going to be Jensen Agribusiness, I believe. And it's Fred, Noah, and Xinjiang. So let me bring up that material. I dig this company, by the way.
Don't forget Brandon.
Brandon, what was I thinking? Of course, Brandon. And yeah, by the way, how could you forget Brandon?
Yeah, right.
Even if you wanted to. Okay. So what do you say you start asking me some questions about these guys?
All right, I have a quick one to start, similar to Megan's. The data we have is 2011 through 2014 numbers, and then a single forecasted year into 2015. And we're looking at an investment standpoint, kind of the same, like, would you want us to think about it at this point in time? We have enough, like, we have what we need to forecast some cash flows or do those models to like today's date. But did you want us to think about it?
Let me give you a couple of things, Noah, that'll help you here. Okay.
Okay.
So a lot has changed for this company since 2015. Okay.
Mm-hmm. I can imagine.
As of the end of 2019, current assets on the balance sheet were 200 million, and current liabilities were about 135 million. You might remember that was kind of reversed. So they just owed a lot of money, a lot of current liabilities back in 2015 when you have the numbers for, I think.
Right, and beforehand, I believe.
Yeah. So they've made some changes here, of course. Now they've also received some pretty meaningful infusion of capital from private equity investors, and that's how this was allowed to happen, or part of how this was allowed to happen. But they're being run better. Is a lot of it. The company's revenue, I think, in 2015 was what, about 1.7 billion, and in 2019 it was just over 4 billion.
2015, you said their actual revenue was 1.7.
Yeah, I think it was about 1.7 billion if I remember correctly.
And then 2019
Got it
was
here
what,
somewhere on even the forms you've got.
And did you say it was up to 4 billion in 2019?
4 billion.
Right, yes.
Yep, 4 billion in gross revenue.
Okay.
Very different story.
Seems like it. So 2011 through 2014, all of those years the debt was exceeding the revenue. Where did this 12.77% forecasted growth, which I guess now it was even above that for 2015?
Yeah,
Did
it
that
actually
number
had
come
better
about?
growth than that.
Yeah, it seems like it. Where did that kind of come about, I guess? Or like that aggressive growth number compared to like not even a 4% growth from 2013 to 14.
Yeah. So I think you have to come back and consider the core of what this business is.
Right.
Jensen Agribusiness is not a farming business.
Mm-hmm.
It's in the agricultural space, owns thousands and thousands of acres under agriculture within parts of the United States. And some of that acreage is used for actual farming. So it's leased out to various large tenant farmers, if you will. And when I say leased, don't misunderstand. It's not like your common renter. Somebody that leases 50,000 acres, okay, and then they're the farmer on it. But but the property is owned by Jensen Agribusiness, and Jensen has the right to farm. How do I put this? Jensen is responsible to keep a certain amount of acres, certain percentage of acreage under their control every year, because Jensen essentially has this property so that they can test out the seed product and the technologies that they're developing. And so it's something like 15% of the acreage under agriculture is able to be used by Jensen for testing purposes, which means the other 85% is the land really is being leased to the various farmers who grow an actual crop there.
Farming. Yeah. Right. Okay.
So the revenue from this company is mostly rents and then technology sales, and technology sales would include the seed product, because they're heavy into engineering seed products. And most of their increase in revenue has been a function of bringing new seed product to market that was previously under development, and then also the increase in yields because of some of their technology. And technology in this case isn't just seed technology. Jensen does a lot within land technology as well, getting more out of a given acre. And then also it's the mapping. So you might immediately start to think about some of the other interplays here. So I told you Leland Manufacturing is the contract manufacturer for Almaden Technology. Well, whose drones do you think are flying above those of Jensen's properties to map?
That makes sense. Could the contract manufacturing be the reason that we don't see any depreciation?
Yeah, so the lack of depreciation isn't really because of contract manufacturing. It's
the land.
Yeah, they engineer all of this, but they don't make any of it. So so it's not like there's equipment that is making seeds, right? Oh, sure. There's combines, harvesters, and all of this, but these guys are pretty smart financiers. They lease all of that.
Right.
All of it. And so the assets that you will on the balance sheet are predominantly raw land, and which is non-depreciable.
Right.
So the depreciation amount is insignificant.
Gotcha.
It's trivial. What else would you like to ask about?
What's their biggest factor in their debt or or their cost of debt? Like, are they? I guess I'm gonna think of a better way to word it. Like, I guess where are they spending the most of their money in order to grow or run business?
Got it. So most of their growth money is in R&D.
Okay.
And clearly some marketing. So you got to think about this company. This is a baby Monsanto. Okay, this is a baby Archer Daniels Midland, ADM. Which, so and it is niche. I mean, if you can call $4 billion in revenues niche, right? But it's in a many $trillion-dollar marketplace globally. Okay, so it's niche, but they've got a couple of interesting products. What else might you like to know?
So I got one. So how does the company dealing with the whole pandemic situation, like the COVID-19?
That's a really good question, Shenzhen. So the good news is that people need to eat, whether they're eating at home, eating at restaurants, which they're not doing, of course, but people still need to eat. And if you look at the grocery business, and this company's seed product is predominantly going to end up on people's tables. It's not seed product that is going to end up feeding livestock and such. It feeds people, and so people are still eating. In fact, my guess, and it's only that, is there was a blip in sales here several weeks ago when if you went into a grocery store, you couldn't find a sack of flour because people were hoarding flour and rice and cornmeal and those kinds of staples. So I'm going to guess that the company may have actually seen then a blip in revenue, not because they sell flour, but they sell the seed. And so that probably increased the seed order for spring, which now is in the ground or about to be in some of these higher elevations. So I'm going to guess that. So I think that means that this company will have seen little, if any, disruption in this respect.
Right.
Now, is it conceivable that a decline in the global population could be sufficient to see a disruption in demand? And my guess is that that's certainly plausible. I mean, in the 1918 Spanish flu epidemic or pandemic, a high enough percentage of the global population died. You clearly saw a decrease in global demand for food product. I don't know that this panic or this crisis has enough of a decline in that respect. I'm going to guess that there's been a bigger effect because of tariffs. And we're an increased understanding in the need for food security, which I think just benefits this company. I don't think it's a disadvantage to it. You're going to see in the next few years that we will import much less in the way of food product into this country than we have in the prior decade. Not only about concern about what comes from out of the country that we then put into our bodies, but also just the concept of food security.
I guess another question I have is that the info we've been given obviously stretches out to the forecast of 2015 and it's now 2020. So you said that they've kind of just been run better and that's why we've seen a change and improvement, but like, do you know like what specifically they did or like how they like maybe re-engineered the like capital components or what they did to initiate that change?
Yeah, and I wish I could tell you a couple of those things, Fred, but I can't. So here's what I can tell you. A couple of seed types that were in development are now in wide distribution and have been in the ground widely throughout the country. Now, not widely like Monsanto widely, right? Okay, this is still niche stuff. But so a couple of products came out of R&D, and I think the company's just done a much better job of posturing itself, positioning itself in the domestic marketplace.
Is there a specific area that R&D is, targeted at for what they want to do with their seed, or?
Yeah.
Newer and better.
So I can tell you that this company's seed product is probably purchased more by small farming operations for things like vegetables, not wheat, for things that would end up on your table as recognizable table product. And the farmers that are growing that product are predominantly selling in the healthy space. So you're probably not going to walk into Smith's and see much, maybe during the summer because of the locale being here in the Intermountain States. But you're not going to walk into Smith's and see a lot of their products, but you'll walk into Whole Foods, you'll walk into Sprouts, you'll walk into any of the natural food providers, and you probably will see products that came from this company's seed. I'm going to guess that the farmers that actually buy seed from them probably have farms of less than a couple of 100 acres each. The company itself has thousands of acres, but it's because it needs this huge acreage to be able to do the R&D, because you test grow seed product not for a season but for multiple seasons when it's been engineered. If it's just being hybridized, that's different, and they do that as well, but it's being engineered. And so it's been a trick to be able to have engineered seed product end up producing fruit and vegetables that have been acceptable to the Whole Foods and the natural food providers of the world, right?
Mm-hmm.
I think that you would find that if you went to one of the higher end purveyors of produce for the restaurant industry, like the climactuses and such, they probably are buying product that is grown from this company's seed as well. But you're talking about niche and higher end. You're not Sizzler, but probably Lakai.
Okay.
Do you know if there was any sort of ballpark value for a potential investment value?
Yes, but it's old enough now that it's irrelevant to it.
Okay.
Not only have the real estate prices changed dramatically,
right,
but the revenue has changed dramatically, which leads you probably then to another question you ought to be asking. This company, again, owns a tremendous amount of real estate, right?
Mm-hmm.
Trying to find this on the balance sheet at the moment. Stay with me.
That's a big portion of their debt.
Well, yeah, a big portion of their debt, sure, but the debt won't have gone up. But the company had fixed assets of 1.4725, right?
Yeah.
So let's just call it $1.5 billion.
Mm-hmm.
I'm going to guess that the market value of that real estate now is probably it probably also exceeds $4 billion.
Oh, wow.
Because real estate values since 2015 have gone up dramatically.
Mm-hmm.
So guys, with that, I think I'm going to cut it. I think you guys have a lot more information than you did. Hopefully you feel like you have enough. I think you do have enough. And remember, you've got as much story to tell as you have numbers to tell it with, okay?
Alrighty.
All right, with that, I'm going to let you go. You have a good day.
So just one more quick question. So for Wednesday, it's just Like we're just gonna explain to the others what we did, how we evaluate the company and our advices or not, like how we changed certain growth and stuff like that.
Back this up with a great story, Martin.
Okay.
Okay.
Cool.
Thanks, guys.